So now think about what I've done so far here. Before the fact, in Twitter, in a video, and in a post, I stated that I'm interested in seeing these taken out, and I like 470 as an interest. Okay, that's a draw on liquidity. So if we're up here, and I'm stating that I think 4070 is interesting, your eye should go to that level and study what is at that level that may be of interest to me. So that way it forces you to dig into the chart. Now, in the beginning, working with me as your mentor, this is going to be very frustrating for some of you, because unfortunately, some of you just want it spelled out for you. And I don't teach that way. You're not going to learn that way, and I'm not going to spoon feed you. And you're going to learn better and more productively by you going in and doing the very things that you would be doing if you didn't need me holding your hand, which means going into the charts, looking for the evidence and details, yourself. So you had a bearish bias given to you. You had an objective, a draw on liquidity, and in the chart here, I'm showing you the framework for the daily range. The opening price at midnight. I teach there typically if there's going to be a down day, which is what I was suggesting, before the market opens at 9:30, we would see a bearish day and look for a draw to 470. If that occurs, your attention should be down between these two levels here, based on that daily chart. Okay. Now, incorporate Power 3. My Power 3 concept is the accumulation of shorts, the manipulation of those individuals that were already short. That's what this is here. That's a Judas swing. The market goes up to a short-term premium, which is high to low, back into a premium relative to this dealing range high and that dealing range low. Then the market breaks lower, trades below the short-term relative equal lows here, retraces, consolidates a little bit, breaks once more, consolidates, and then attacks the sell side here and aggressively runs through the 470, which is what we were anticipating based on my commentary before the market opened. And then we take our attention down to here. So if you are short, you take a partial here, then you wait for the daily range to fulfill. That means you have to submit yourself to time. What time? 3 o'clock to 4 o'clock. Wait to that last hour of trading, because you'll get the delivery of price when it trades down into that. All right, now we have the 15-minute time frame on the left-hand side and the 5-minute chart on the right. You can see how we rallied up into that fair value gap on the hourly. We broke down. Once more, traded back above the opening price at midnight here. Breaks lower, consolidates. All of this we'll talk about later in the video. Then breaks once more, trades up into a fair value gap here. Breaks lower and aggressively runs into that higher time frame daily fair value gap. On the 5-minute chart, you can see here we have the equities opening at 9:30 a.m. here. And I mentioned when we were down here, I said price is initially showing weakness. It's going lower. Traders are going to get caught short doing that, chasing price going lower. They're going to reprice to 41.05. There's buy side liquidity resting there and a fair value gap. The market immediately after my post runs to that level. I engaged that with a demo trade. I entered it and I took profits below that short-term low here. And then I'll teach you how I knew this was reversing on me and saved my stop, and also took a second partial off. It rallied up once more, blowing out that short-term high. So we have a lot of chop in the initial opening range. Low, higher high than that high, lower low than that low, lower low again, then rallied through this high and left this fair value gap. Consolidated a little bit in here, traded back down in, once more back into the opening price at midnight, which is this line here. If you're bearish, you want to be going short at or above that level, or as close as you can get to it, like this one here. Okay, the market drops down between 11 o'clock and noon. It consolidates, then retraces back up, takes buy side here, breaks lower, returns back to a swing low, which we'll talk about in a moment, breaks lower again, aggressively runs for that 470 level, and it's off to the races down into the daily fair value gap. Now, if you look at the daily range through the scope of a 5-minute chart here, you can see the opening price here at midnight. Prices gravitates around that. And in London, they rally and start building in a premium ahead of the 8:30 time window. The market creates the high, breaks, takes out short-term sell-side liquidity here, retraces back up into, consolidates for the majority of the afternoon, then it breaks lower, and then aggressively attacks the sell side below 470, and then going right back down to that 440 level, and then hanging out and consolidating and closing inside that larger daily fair value gap. Now, I want you to take a look at this price action here. We're looking at the afternoon. So with the morning aside, because I walked everyone through that basically on Twitter and with pre-market analysis and commentary. The rules for a afternoon session trade. Before you even consider trading in the afternoon session, you have to consider, what is the daily range trying to do? Is it trying to expand higher? Is it trying to expand lower? Did it reverse in the morning session? And is it going to have a counter trend move? Or is it going to just consolidate because it's waiting on a big news event the following day? Today, we had a big news event. We had employment data. The market consolidated. And we had a bearish bias. We were looking for 40.70 based on my experience. I was generous enough to give that to you beforehand with commentary suggesting that we would trade down into that lower time frame fair value gap on the EMA S&P's daily chart. So the framework was one-sided. It was not ambiguous. It was specific about what we were looking for. Once the market started to break after lunch, when does lunch end? At 1 o'clock in the afternoon, New York local time. That is here. So 12 to 1. There is our New York lunch. If we're bearish, what did I teach you? The market will do what? It will clear the stops during the lunch hour. What highs were formed in the lunch hour? Here, and prior to it going in, this was the buy side liquidity pool or short-term high. So at 1 o'clock, the algorithm reprices and runs to take the stops above the buy side here. So during the lunch hour, we're seeing that it took the stops here. You can, if you're aggressive, you can put on a trade here because we're in a directional move. We're trying to anticipate a large range day, and large range days can typically form with a busy lunch schedule. And I just recently taught this, that the market, if it's going to be a fast market, during the lunch hour, it can create a significant high or significant low. But the premise mainly is, if you're bearish, you're going to be looking for the highs to be swept because they don't want participants to be profitable that may have assumed a short position from the morning session, or prior to this high forming, they may have already been short here, and instead of letting the market release and break to a lower PD arrays in a discount market, the algorithm reprices, knocks those individuals out because it floods the market with what? Buyers at a higher price. Higher than what? Than it was here, than it was here. So smart money utilizes this run above this short-term high as an influx of buying interest and liquidity that's available immediately while the market's being priced here and held at that level. Smart money will go in and sell to those buyers that their orders will be resting above here. So their stops are being tripped. Their short position is being knocked out. And conversely, there's traders that would see that high being broken as a means of getting long, and they have a buy stop that would trigger them getting in on a breakout. So smart money is cannibalizing those two types of orders. What orders are they? Buy side liquidity. So the counterparty to their short has to have buying interest. That buying interest is being engineered by the algorithm when it runs up here. So smart money goes short here with the expectation that they can take off a portion here back to an old low of 470 and then 440 and then into that fair value gap on the daily chart. Now, sticking to the rules of the model I'm trying to teach you, if you do not trade during the lunch hour, that's fine. You're going to wait until after lunch for a setup to form. Those of you that have been studying my channel here on YouTube, you understand that this swing low here to a higher high than that of here is a breaker. Okay, that's my ICT bearish breaker. What is a breaker? A breaker is a pattern where price runs out a pool of liquidity. In this case, it's a buy side liquidity pool. And then it reverses and trades back down below that short-term low. If it trades back up to that and the narrative is bearish, notice that it's not just simply we have this pattern here and that's all it is. No, you must know what the market's likely to be reaching for. If you leave that out, it's not a breaker. It's a gamble. It's a guess. It's a speculation that's aimless. Notice the difference there? So this down close candle, the lowest one prior to the move up, clearing that short-term high, and I teach this on the YouTube channel. So if you've already gone through the 2022 mentorship videos and you're caught up, you're welcome to go through the other videos as well. But I'm trying to keep your focus in this series because it's very easy for you to go into other series on this YouTube channel and get inundated with things and create so many questions that will feel like they are pertinent to this model, and they're not. Okay, but I'm just giving you a comprehensive view of what it is I look at in price, what I'm judging, whether or not is it likely to continue going lower. And as price starts to move back up into this level, I would expect and anticipate that level repelling price and go lower, and then be aggressive about trading below that because there's sell side there, and then not going below this low here to go higher. We want to see it go through there and accelerate going down. It wants to run quickly for that 40-70 level because there's a larger pool of liquidity below that, and then aggressively run into that fair value gap on the daily chart because that's the imbalance that the algorithm is going to want to reprice to. In the afternoon, obviously you can see post breaker being traded to. Heaviness falls below 40.70 and then accelerates. See that? See how fast it accelerates down? Small little consolidation, no retracement, no return back to an old low broken. Support becomes resistance. Forget about it. This is an algorithmic sell day. Retail doesn't get to do a lot of those retail concepts. You either are on board beforehand or you watch the ship sail off without you. Okay, and that's basically what you end up seeing here in the price of 440 gets traded through and back into that daily fair value gap, as I mentioned, would be the likely target for today.